MACD indicator when trading crypto. You've found the perfect resource. Dive into this guide for expert insights. The moving average convergence/divergence, MACD, is a widely used technical analysis indicator in the field of financial analysis. Developed by Gerald Apple in the late 1970s, MACD has become one of the most popular technical indicators used by traders and investors. Its ability to identify potential trend reversals and generate a buy or sell signal makes it a favorite among crypto traders. But many traders still struggle to fully understand the full potential of MACD and use it effectively. In this detailed video, we show you the components of the MACD indicator, interpret its signals, provide practical tips, and explore its potential application in different market conditions. What is the MACD indicator? The MACD indicator consists of three main components: the MACD line, the signal line, and the histogram. It is crucial that you first understand the role of each component so you can interpret MACD signals accurately. MACD line. The MACD line is calculated by subtracting the longer-term exponential moving average EMA from the shorter-term EMA. It represents the difference between the two exponential moving averages and is used to identify potential trend changes. Signal line. The signal line is a moving average of the MACD line and is typically a 9-day EMA. It smooths out the MACD line's fluctuations and generates buy or sell signals when it crosses above or below the MACD line. MACD histogram. The MACD histogram represents the difference between the line of the MACD and the signal line. It provides a visual representation of the convergence and divergence between the two lines, indicating the strength of the trend. In this video, you can learn extensive and understand deeply about MACD indicator, and we cover different topics about MACD indicator. Details of topics are following as 1. MACD 2. What is MACD 3? Calculating the moving average convergence/divergence. 4. How to interpret MACD indicator signals. 5. How to use MACD for trend identification. 6. Positive and negative divergence. 7. Determining trend strength. 8. MACD and RSI. 9. MACD and volume. 10. Limitations of MACD. 11. How reliable is the MACD indicator? 12. Can MACD be used for swing trading? Calculating the moving average convergence/divergence. In order to gain insights into the MACD's underlying mechanics and interpret its signals effectively when trading crypto, it's important that you understand how the MACD is calculated. The calculation involves the following steps. Short-term exponential moving average EMA. You can calculate the short-term EMA by giving more weight to recent price data, which results in a more responsive line. Long-term EMA. The long-term EMA provides a smoothed representation of price movements over a longer period, reducing short-term noise. MACD line calculation. You can calculate the MACD line by subtracting the long-term EMA from the short-term EMA. Signal line calculation. The signal line is usually a 9-day EMA of the MACD line. Histogram calculation. To determine the histogram, you must subtract the signal line from the MACD line. How to interpret MACD indicator signals. You can interpret buy and sell signals with the MACD through crossovers and divergence. MACD crossovers. Crossovers occur when the MACD line and the signal line intersect. A bullish crossover happens when the MACD line crosses above the signal line, suggesting a potential uptrend. On the other hand, a bearish crossover occurs when the MACD line crosses below the signal line, indicating a potential downtrend. Divergence. Divergence refers to a difference between the direction of the price and the MACD indicator. Positive divergence occurs when the price action forms lower lows, while the MACD line forms higher lows, suggesting a possible trend reversal. Negative divergence occurs when the price action forms higher highs, while the MACD line forms lower highs, indicating a potential trend reversal. How to use MACD for trend identification. One of the primary applications of the MACD indicator is trend identification. Understanding how to interpret buy and sell signals with the MACD accurately can help you identify potential entry and exit points in the market. Bullish and bearish line crossovers. Crossovers between the MACD line and the signal line can provide valuable insights into trend reversals and a potential buy or sell signal for trading opportunities. Bullish MACD crossover. A bullish MACD signal line crossover occurs when the line of the MACD crosses above the signal line. This signal suggests that the short-term trend is turning bullish, indicating a potential buying opportunity. Bearish marked crossover. A bearish MACD signal line crossover happens when the MACD line crosses below the signal line. This signal indicates that the short-term trend is turning bearish, signaling a potential selling opportunity. False signals and confirmation. It is essential that you consider the occurrence of false signals and seek confirmation from other technical analysis indicators or price patterns before taking trading actions solely based on MACD signal line crossovers. Positive and negative divergence. Divergence between the MACD indicator and the price can provide you with valuable insights into potential trend reversals. Positive divergence. Positive divergence occurs when the price forms lower lows, while the MACD line forms higher lows. This signal suggests that the selling pressure is weakening and a potential trend reversal to the upside may occur. Negative divergence. Negative divergence happens when the price forms higher highs, while the MACD line forms lower highs. This signal indicates that the buying upward momentum is waning, and a potential trend reversal to the downside may be imminent. Identifying trend reversals. Positive and negative divergences can serve as early warnings for potential trend reversals. However, it is crucial to confirm these signals with other technical analysis indicators or price patterns before making trading decisions. MACD determining trend strength. You can use the MACD histogram to assess the strength of a trend. MACD histogram. The MACD histogram represents the difference between the MACD line and the signal line, providing a visual representation of the convergence and divergence between the two lines. A rising MACD histogram indicates increasing momentum, while a falling MACD histogram suggests decreasing momentum. Zero line. The position of the histogram relative to the zero line can also provide insights into trend strength. Positive values above the zero line indicate a bullish trend, while negative values below the zero line indicate a bearish trend. With the Relative Strength Index, RSI can enhance the accuracy of trend analysis and identify potential overbought or oversold conditions. Overbought and oversold conditions. When the RSI reaches overbought levels, for example, above 70, and the market generates a bearish crossover or negative divergence, it suggests a potential reversal to the downside. On the other hand, if the RSI falls to oversold levels, for example, below 30 and the market shows a bullish crossover or positive divergence, this suggests a potential upward reversal in the market. Convergence and divergence. When you observe convergence between the MACD indicator and the RSI, it can offer you additional confirmation of the current trend. On the other hand, if you notice divergence, it may signal potential reversals in the trend. MACD and volume. By analyzing volume alongside MACD, you can gain valuable insights into the strength of price movements and potential trend reversals. Volume confirmation. When the MACD generates a bullish crossover or positive divergence accompanied by a significant increase in trading volume, it provides you with a stronger confirmation of a potential uptrend. Similarly, a bearish market crossover or negative divergence with a surge in volume offers you a stronger indication of a potential downtrend. Volume divergence. Divergence between volume and the market indicator can signal a potential trend reversal. For example, if the price forms higher highs while volume decreases, it may indicate weakening buying pressure and an impending trend reversal. Limitations of MACD. A moving average divergence can signal a possible reversal, but it will also produce numerous false positives along the way. False positive divergences often occur when the price of an asset moves sideways in a consolidation, such as in a range or triangle pattern. A slowdown in the momentum sideways movement or slow trending movement of the price will cause MACD to pull away from its prior extremes and gravitate toward the zero lines, even in the absence of a true reversal. Confirmation should be sought by trend-following indicators, such as the Directional Movement Index DMI system and its key component, the Average Directional Index ADX. The ADX is designed to indicate whether a trend is in place, with a reading above 25 indicating a trend is in place in either direction and a reading below 20 suggesting no trend is in place. Investors following MACD crossovers and divergences may double-check with the ADX before trusting a MACD signal. While MACD may show a bearish divergence, a check of the ADX may indicate that an uptrend is still in place. Such a double-check may help investors avoid the false bearish MACD trade signal and allow them to wait and see how the market develops. If MACD shows a bearish crossover and the ADX is in non-trending territory and has likely shown a peak and reversal, investors may be more willing to take the bearish trade. How reliable is the MACD indicator? The MACD is most reliable when used in trending markets and less effective in choppy, sideways markets where it can generate false signals. No indicator is 100% accurate. MACD signals should be confirmed with other technical analysis tools or price action. Research suggests the MACD performs better in strongly trending markets and when combined with additional confirmation signals. For best results, avoid using MACD in isolation. The MACD is most reliable when used in trending markets and less effective in choppy, sideways markets where it can generate false signals. No indicator is 100% accurate. MACD signals should be confirmed with other technical analysis tools or price action. Research suggests the MACD performs better in strongly trending markets and when combined with additional confirmation signals. For best results, avoid using MACD in isolation. The MACD Moving Average Convergence-Divergence Indicator is a popular and effective tool for gauging momentum and trend changes. Its reliability is highest in trending markets uptrends or downtrends, where its signals, like line crossovers and divergences, are more robust. However, the MACD is less reliable in choppy or sideways ranging markets, where it can produce frequent false signals, whipsaws. As a lagging indicator based on historical prices, its signals can sometimes be delayed.
Swing Trader Approach. Swing Trader Approach under the utilizing daily and 4-hour charts. As the neophyte begins to gain some forex trading experience, he can move on to the swing trader approach that introduces a little variability. This approach can be said to act as a bridge between the longer-term approach and the shorter-term approach. With this approach, the trader can benefit by eliminating the negativities of the other two approaches. The swing traders often minutely follow the chart all day long to identify and analyze the big moves in the market. Thus, the trader need not necessarily watch the market he is trading in continuously. If they find a situation that is akin to the one they have already studied, they can open or close a position, as the situation demands. The traders can also use the stop-loss tool that will reduce the losses. The major advantage of this approach is that trader can continue to look at the trading charts such that they do not miss out any opportunity and at the same time do other activities. The daily chart is utilized by the swing traders to determine the trend of the market while the 4-hour chart specifically talks about the entry and exit point. Indicators like MACD, stochastics and CCI are often used along with the 4-hour chart for placing positions.